Hi, AG Squared here. One of the hottest topics as of late is that affordability in one's life today is the worst it's ever been at. That's due because of incredibly stubbornly high home prices, very high cost of education, a relatively high inflation, and incomes not keeping up with this high cost of living. So what is one to do in situations like this? And there's two things I like to remind people that they have in their control. One is to be able to track where their expenses are going. And two, it's to be able to budget what it is that they ultimately want to see their expense distribution look like based on where they are at in their life today and where they see their lives being in 1, 2, 5 years from now. And in this video, I'm going to show you the detailed steps in how I've done this since 2015 at the approximate age of 21 or 22 years old. So let's get started. The first thing I recommend people to do is to start creating a budget. And you can see here, this is my budget. It's nothing fancy. It's one Excel sheet and it basically just covers a few things. First and foremost, what is my estimated tax bracket income? And that's something we can look up online depending on your lifestyle and whether you're single, married, and your income levels. Second is your salary. And then after that, a lot of these cells are just simply calculations, such as my income per month is nothing more than my salary subtracted by the amount that I would take for taxes divided by 12, and that's my income per month. And then my net paycheck per month is my income per month subtracted by the amount I put out for retirement every single month. So some of these cells, their calculations may change depending on yours. But again, the key takeaway here, folks, is the principles. Based on how much you're bringing in every month, what are the different types of expenses you're looking at? Things could be, in my case, I have a side business where I actually invest in real estate. So I've got a rental property fund where, as you can see, I'm putting up a whopping almost 35% of my monthly income towards reinvesting in that. The second highest expense is savings per month. I am saving to further invest in other assets or just simply for a rainy day fund or just maybe simply for something, a vacation I want to take at the end of the year. I'm saving 17% of my monthly income. Followed by that, I've got my monthly housing plus utilities plus insurance, really just being able to put a roof over my head at about 16.5% of my monthly income. This year, I also had a car payment of a whopping $1,300 a month, which made up about 13.4% of my monthly income, and so on and so forth. Again, the key here is these categories may change based on what your lifestyle is. If you've got a young family, you're gonna have to probably be a little more specific around daycare, babysitters. The goal here, folks, is to start capturing where your money is being spent in and for you to keep track of that over a course of 1, 2, 3 months so that ultimately you can start landing on what is that realistic and viable distribution that is healthy for you. Yes, if you look up online, you'll find that some places they recommend no more than 30 to 33% of your monthly income going to housing. Same thing for food. And there's all these generic, all-encompassing ratios that people recommend. Those are a baseline, and they're good to get an initial idea on where you land. But always think your lifestyle may be different. And what goal here is to reach a sustainable, realistic budget based on where you're at. So that's my first recommendation. Start being able to account where your money is going so you can land on something that looks like this. What's interesting here is in another previous video of mine, I talk about how the key about wealth generation is as you increase your income and the amount of money you're bringing in, that you want to keep your cost of expenses about the same. And that gap of amount left over to invest continues growing and growing every year. And that is the definition of wealth generation. And if you look at this distribution, make note, about 16% goes towards housing, 13% goes to car, 8% goes to food. Let's take a look at what 2015 was when I just recently graduated out of college. Monthly housing was about 23%, slightly higher. Food and water, 21%, slightly higher. But look at this. I was irresponsible right out of college. I was putting about 16% of my monthly income towards gambling. And even then, I was still saving approximately 43% of my monthly income towards some form of investing. And again, back then I was making higher above mean average salary. I was making about $87,000 a year. But again, this goes to show you the power of being able to track where your expenses are going and holding yourself accountable throughout year by year to make sure you're not losing discipline in any of these areas. And of course, life changes. That's fine. But don't let it change too drastically where you start losing control and line of sight as to where your money is being spent in. So again, this is step number 1, landing on a budget. Step number 2 is keeping on track on that budget. And that is where keeping track of your daily expenses comes into play. And I have this awesome Excel sheet that I've been using since 2015, again, right out of college, to keep track of every single expense I've done and categorize it based on the categories I have defined, including when it happened, what was the item, how much was it, and the month and year. Yes, there's a lot of tools out there, whether some people prefer doing physical budgeting on paper, other people might love mobile application and browser-based budgeting. For me, the power of Excel does the job, but I'm happy to help you get to what works best for you. In this particular example, as you can see, let's take a look at what recent out-of-college agent was spending money on. I actually find it quite amusing. I'm spending money on chili, beans, jam, pasta sauce, canned soups, bread, pizza. Lo and behold, ramen. Shocker, right? A recent college graduate decided not to learn how to cook, buys a ton of ramen. I also have, as we can see, milk, water, shocker, poker, insurance, dishwasher detergent, a sink set, chapstick, hand soap, stuff. I don't know what that is. I only spent $5.30 on it in 2015, so I'll let y'all kind of guess on what that was. Pringles, important. Toilet paper, necessity. That's why it's in clothing and necessities. Scissors. Always got to have a pair of scissors. And a car inspection. That's 2015, y'all. And the key here is you can see I've had 4,934 entries since the start of this today of individual expenses I'm tracking. That's the type of discipline that I think is worth striving for. It's not always sustainable. It's not for everyone. There are better ways probably of tracking this using things like QuickBooks and plugins from all your credit card companies and other bank institutions. Key takeaway here, folks, is this insight is valuable. For example, once I input this in this one sheet with the template I have here, the Excel file, I do no changes to basically be able to get a breakdown based on year, based on month, based on category, where my money is going every single year as I'm scrolling down. And again, this is just simply a way of putting this data information in a tabular format. The real value comes in visualizations. This visualization to me is empowering because it tells me if I've had a life-altering moment where I've saw a drastic change in my expenses and be able to reflect on it. Is that sustainable? Is that something I need to start accounting for? Do I need to set up a new goal, redistribute where I'm spending money on? Okay? It's called a layer chart. So it basically tells you based on volume, how much of each category you're spending in. And so you can see here that obviously the biggest leap in ratios is the jump of housing and utility. And that's not because I moved into $1 million home, y'all. It's because I opened up my real estate business in 2018 and it really started shooting up in 2020 where I started doing a ton more house acquisitions, renovations, repairs, and just started scaling up my business. And a big thing I'm very proud of is you can take a look at the poker amounts. You can see how that's become thinner over the course of from 2015 to 2023. That's not by mistake, y'all. I started realizing how much money I was frankly just burning due to gambling where I could have put it somewhere else. And another increase you see here is my utilization on a car. In approximately since 2015, I was blessed that my parents gave me a car that was paid off. I had no car loan. Yes, I am privileged for that. I am humbled, but I didn't waste it on simply buying another car and having two cars, one to drive, one to show off. I said, I'm going to drive a fully paid car for approximately 7 full years. And then actually technically it was 6 years. And then I bought a car fully out of pocket cash. And then I drove that for about 2 years, not paying any loans and anything. And that's why you don't see any car payments in 2020, 2021. But in 2022, I bought a car. I bought my Ford F-150 Lightning EV, fully EV. I love it. Horrible financial choice, but you can see the distribution in terms of how much that accounts for. And if you actually look at the percentage based on our budget in 2023, my proposed car payments is within the recommended 10 to 13 to 15%, depending on who you talk to. Okay, so now that we've got this visibility, right? We now are gonna jump over to year and year over year from 19 all the way to 23. How do I hold myself accountable? Well, let's look at 2022. This red line is effectively based on my budget, how much every month I should be spending, excluding savings, excluding investments. It's actually things that I'm buying and acquiring for my living. 2022 was a little tough, right? I exceeded this red line across the whole board. That's okay, it happens. No one's perfect. I was aware that I was having high costs in that year, and I simply said, I'm gonna be saving less. But let's take a look at 2019, y'all. 2019, I know it's hard to read. The accumulation of that is below, for the most part, all below that red line. I met my budget and was able to save that amount of approximately 40 to 50%, even higher at times, depending on the year, of my monthly income and then reinvest it in myself or in investments. Same thing for 2022. Let's zoom in. 2022, practically my total expenses every month below this red line based on what I budgeted I should expense. 2021, same thing, high discipline year, practically within the budget line. Again, saving everything I wanted to save. 2022, we started getting a little more expensive. 2023, practically relatively around the line, a little over. So we've got room for improvement. So I want to conclude this talk to address, yes, we live in a tough time. Affordability is an absolute killer, very hard to achieve. Cost of education, cost of living, cost of goods, consumers price index at a high, while inflation's still relatively high and incomes are not keeping up with things. What do you control, folks? You control budgeting. You control tracking expenses. You control being wise in terms of where you're putting your money to work. So let me know how I can help. Call to action here is reach out to me, reach out online, find how you can start budgeting, find how you can start tracking expenses, gain control of that piece, and you will find that that will open up a plethora of doors for you to now feel much more empowered to decide how you can increase your income, how you can increase your investments, how you can overcome this challenge of affordability. I hope this was helpful for you all, and thank you for tuning in.